All right, welcome to this explainer. Let's just dive right into it. Today, we're unpacking a hidden truth about one of the most frustrating, just absolutely account-draining phenomena in trading, the reversal trap. We're going to demystify how the market constantly fakes a reversal, especially in super volatile assets like Bitcoin or gold, right before violently continuing its main trend. But more importantly, we're going to learn exactly how you can trade these setups without getting caught on the wrong side. We're talking about how to actually fade the false breakout, align yourself with institutional money, and ride that original trend for maximum profit.
Seriously, how many times have you been caught trying to catch a reversal way too early? I mean, we've all been there, right? You see this massive red candle on Bitcoin and you think, okay, this absolutely has to be the bottom. So you buy in and then boom, it drops another 10% and totally wipes out your position. Or maybe you see gold shooting up, you aggressively try to short the top and you literally just get stopped out instantly as the rally pushes even higher. It's incredibly frustrating. You end up letting your emotions dictate your entries, while the institutional players are just quietly taking the other side of your trade. You are definitely not alone in this, but it's a vicious cycle and we have to break it.
So, to fix this, we need a game plan. Here's our agenda for today. First, the anatomy of the trap. Second, retail versus smart money. Third, the step-by-step setup. Fourth, real market execution. And finally, risk and psychology. Let's get to it.
Okay, Section 1, Anatomy of the Trap, and the Lure of the Turn.
Before we can avoid a trap, we have to know what we're looking at. Basically, a classic reversal strategy is a technique used to identify potential points where a market trend exhausts and changes direction, allowing early entries into new trends. The lure here is obvious, right? You want to capitalize on early directional shifts while keeping your risk super tight. But there is a massive catch. This exact desire to catch the bottom or short the exact top is exactly what institutional players use against you to build their trap. They know retail traders are desperate to get in on the ground floor of a new trend. So what do? They artificially manufacture conditions that look exactly like a reversal, specifically to lure impatient capital into the market before they just resume the original trend.
Now, there is a totally crucial difference between a real reversal and a trap. A real reversal relies on waiting for confirmed structural exhaustion, meaning the market actually proves it has run out of momentum. A false breakout trap, on the flip side, totally preys on the impulsive retail habit of jumping in on pure emotion, fading an active trend without any structural confirmation whatsoever. The market will often create this reversal-looking move like a massive strong candle against the prevailing trend just to sweep liquidity zones. It grabs everyone's stop losses, whips up a frenzy of early entries, and then violently snaps back into the original direction, leaving all those retail traders trapped.
Get a load of this statistic: 45 to 60%. According to our source data, that is the remarkably high rate at which reversal signals completely fail. I mean, really think about that for a second. Even with a setup that looks perfect, roughly half the time, the market is just faking you out. This is the harsh reality of financial markets, and actually, it's exactly why trading the continuation of the original trend after the trap is sprung is usually way more profitable than trying to catch a falling knife.
All right, moving right along to Section 2, retail versus smart money, and the actual mechanics of the trap.
Look, every trend eventually runs out of fuel. The key is finding the structural exhaustion. But here's the thing, a trend doesn't just stop on a dime and immediately reverse. It sputters. And smart money uses that sputtering to their advantage. Large institutional players have massive orders to fill. If they want to buy a huge block of Bitcoin during an uptrend, they need sellers. And where are all the sellers? They're clustered as stop-loss orders right below the recent lows. That's a liquidity pool. Smart money will deliberately push the price down just enough to trigger those retail stop-losses, creating a classic false breakdown trap. They scoop up all that liquidity, their orders get filled, and boom, the asset skyrockets back in the direction of the original strong trend.
Because of all this manipulation, you literally cannot just guess. You need solid proof before putting your capital on the line. You've got to look for these three converging signals. First, structural exhaustion, meaning the price reaches a key prior high, low, or liquidity zone. Second, volume divergence. This means the final push into that level happens on declining volume, proving there's less participation driving the move. And third, candlestick confirmation. And here is the kicker. If these three signals fail to fully materialize, the trap is confirmed, and the original dominant trend is almost guaranteed to resume. That right there is your cue to trade the continuation.
Which actually brings us perfectly into Section 3, our step-by-step setup. This is where we stop guessing and start waiting for proof.
I want you to treat these 4 steps like an absolute, uncompromising checklist. Step 1. Identify your strong trend direction first, higher highs or lower lows. Then mark your key liquidity zones and wait for an exhaustion candle at a major support or resistance level. Step 2. Confirm volume divergence on that final push. Step 3, and honestly, this is where most impatient traders completely blow it. Wait for the pattern to finish forming. The candle absolutely must close. Now here is the real pivot for trading the trap. Step 4, watch for the trap confirmation. If that reversal attempt fails to follow through and you get a wick rejection while the original structure holds, you enter in the direction of the original trend. You get in on the break of the confirmation candle and you basically ride the momentum of all those trapped retail traders who tried to call the bottom.
But to recognize these traps, you have to understand the bait. The most reliable candlestick patterns for this are engulfing patterns, hammers, and morning or evening stars. Seeing these specific patterns is exactly what retail traders are trained to look for, because they're in literally every beginner trading book. Smart money deliberately paints these exact candles on the chart to lure retail in. A beautiful hammer forms, retail buys the reversal, and then bam, institutions immediately slam the price back in the direction of the original trend. When you see these textbook patterns fail to follow through, you know the trap is officially set.
Okay, let's look at a real-world example to lock this in. Section 4, Real Market Execution.
So even though this setup maps out a Tesla trade from our sources, the math and logic here play out identically on Bitcoin and gold every single day. The asset pushes into a key historical support level on declining volume, a bullish engulfing candle forms, closing at a specific price. Here, it's $261. But instead of just blindly jumping in, you wait for the mathematical trigger. The entry trigger is a precise break above the confirmation candle. Your invalidation point, which is your absolute hard stop loss, is set strictly outside the trap zone, just beyond the exhaustion wick. You take a partial profit at 1.5 times your initial risk, and then you trail the rest of the position. Whether you're attempting a highly confirmed reversal or you're fading a failed setup for trend continuation, your execution has to be this precise and emotionless.
And speaking of execution, your exit rules have to be completely universal and absolutely ruthless. First, set your stop loss beyond the exhaustion wick. That wick represents the extreme edge of the trap. If the price goes back beyond that point, your thesis is completely invalidated and you need to be out, period. Next, take that first partial profit at 1.5R to lock in gains. This instantly removes the psychological pressure. Then, just trail the remaining position using prior swing levels. Finally, exit fully if the price reclaims the original exhaustion zone. Honoring these rules, that's what separates the professionals from the gamblers.
This leads us to our final, and honestly probably the most important section. Section 5, Risk and Psychology, Surviving the Trade.
Let's be real for a second about the fatal flaws that routinely wipe out retail traders. Entering before a pattern actually completes is a massive one. You just have to wait for the candle to close. But the deadliest flaw, ignoring higher timeframe trends. If you're out there trying to catch a 15-minute bullish reversal on Bitcoin, but the daily chart is printing massive lower highs and lower lows in a raging bear market, you are going to get completely run over. The psychology of wanting to outsmart the market by calling the exact bottom feeds right into institutional traps. And the ultimate cardinal sin? Moving your stops wider. When the trade goes wrong, just take the paper cut. Never, ever move your stop to give a losing trade more room.
To protect your capital, our sources offer this absolutely golden rule. Reduce your position size by 50% when trading against a strong daily trend. Seriously, if you stubbornly decide that you just have to take a reversal setup against dominant market momentum instead of trading the continuation trap, cut your risk in half. This drastically limits your exposure during those highly volatile areas where false breakouts and liquidity sweeps are at their most vicious.
Now remember that crazy failure rate we talked about earlier? Take a look at these outcomes. Your target win rate for these setups is only 40 to 55%. The false reversal rate is astronomical. Even with absolutely perfect setups, you are going to lose frequently. And this is exactly why a 2-to-1 risk-reward ratio is totally non-negotiable. You have to ensure your winning trades are significantly larger than your losing trades simply because the market is designed to fake you out. Strict risk management is basically your only true defense against institutional algorithms.
I really want to highlight this quote from our sources. You are not guessing tops and bottoms, but waiting for the market to prove the turn. Adopting this requires the complete destruction of your inner hero complex. Your goal as a trader isn't to look like a genius to your friends by calling the exact dollar top on gold or the very bottom on crypto. Let the impatient retail traders try that and just watch them get stopped out.
Your goal is to be consistently profitable by trading confirmed structure. Be the patient, methodical trader who lets the market tip its hand first.
Master your patience, respect those liquidity zones, and trust the overall market structure over your temporary emotions. You really don't need to be the hero who catches the absolute bottom. Stop letting smart money use your impatience as their liquidity. So I'll leave you with this. Will you trust the structure over your emotions on your next trade? Let us know. Thanks for hanging out with me for this explainer, and stay disciplined out there.